Good afternoon. Welcome. Thank you all so much for joining us. I'm Josh Schimmels, publisher and CEO of the Los Angeles Business Journal. It's an honor to be hosting now our 27th annual Commercial Real Estate Symposium and Awards. Today kicks off our two-part series with three outstanding panel discussions. Then next Wednesday, we'll be announcing this year's award finalists and winners in many categories. And I'll tell you, we're looking forward to sharing our picks for this year's biggest, best, and most notable projects and transactions. But first today, our expert panelists are going to weigh in on the latest trends and developments impacting the greater Los Angeles commercial real estate market. We've got three panels lined up with a lot of great information to be shared. The first is going to focus on the office conundrum. And I think we all see it is quite a conundrum, so I'm excited to hear that panel. The second is on industrial trends, which we've seen a lot of activity in a lot of different directions over the last 2 years. Curious to see where that's going. And then we're going to talk about what we're seeing on the horizon from a development standpoint. And I think next week's awards are going to show just how much development we've seen over the last 24 months. We did receive many questions from our audience members throughout the registration process. We've been able to incorporate those into today's Q&A. So many thanks to those of you who've already helped to shape our conversation. During the panels, we're going to be conducting live audience poll questions. So when you see them pop up on your screen, we'd love for you to share your experiences with us. We'll then publish the collective responses online next week. I obviously want to take a moment to thank the tremendous group of sponsors for their involvement in this program, next week's awards, and of course, for their continued leadership in the real estate community. We absolutely can't do this without you. Special thanks to our two platinum sponsors, Colliers and Farmers and Merchants Bank. Also, many thanks to all of our gold sponsors, Bridge Industrial, Christina, Crexi, Matt Construction, NAI Capital Commercial, Newmark, Altman's Construction, Prologis, Sierra Pacific Constructors, Trammell Crow Company, Turner, Webcor, and ZGF. Thank you all so much. All right, we're going to start talking real estate with our first panel covering the office conundrum. So please welcome Joseph Faulkner, President Brokerage with NAI Capital Commercial, Laura Stum, Senior Managing Director, Newmark, Grafton Tanqueray, Executive Vice President, CBRE, and our moderator, Jody Poirier, Executive Managing Director with Colliers. Jody, welcome back. It's good to see you.
Thank you, Josh. Good to see you as well, and everybody else. I assume you can hear me okay. Let me know if not. Well, I'm excited to talk with all of our panels today about the office conundrum. And although we're not in person this year, at least I can say I'm in the office this year, whereas we did this last year, had to do it from home in the middle of lockdown and was very nervous my dog was going to bark and make noise during this. So if there's any barking, that's just my brokers in the background. So let's go ahead and kick off. A general question for our group here. We're going to start with really an open-ended one. And last year, we spoke about the new normal. That was the term we kept hearing, the new normal. Well, now, fast forward a year, that normal is no longer new. It seems to be our normal. So what does the future hold in terms of the return to office and office demand? And Grafton, I'm going to start with you. There, Grafton, are you on mute? If not, Laura.
Is that better?
I got you, Grafton.
All right. So sorry about that.
There we go.
Thanks, Jody. So we see companies wanting to come back, but yes, we're in hybrid modes. CBRE research sees remote work on average of about 1.5 days a week going forward in comparison to about a half a day pre-crisis. In addition, we see about a 10% reduction in dedicated space per employee, but significant increase in we space out there. Overall, it's probably kind of a wash. And companies will begin to increase hiring, at least that's what we begin to expect. CBRE expects that we'll have a full office recovery in between 4 and 4.5 years. In comparison, by the way, to about 6 or 7 years with the dot-com bust in 2001 and the financial crisis correction in 2008. Back to you, Jody.
Thank you, Grafton. So it sounds like research-wise, they're telling us about 4 years until we get back to pre-pandemic levels.
That's what we're hearing. And, that's going to depend on market to market. Every city is going to be a little bit different, and every submarket, every city is going to be a little different. But that's kind of what we're seeing nationwide average. Yeah.
Laura, what about you in terms of what you're seeing with, the return to the office demand, and let's talk a little bit more, pinpoint more Greater Los Angeles.
Sure. So, I'm sitting from a capital markets hat. So I typically see what is office demand, and then how does capital perceive that office demand? So what we saw in both 2020 and 2021 was really a very strong push for single tenant buildings to come to market. A lot of that was driven by low interest rates, low hedging costs, and it was very easy for these large tech, media, life science companies to place bets on markets, just because there was a long-term outlook that if they needed to be in a space, that asset was then liquid. What we're seeing for the first time, what we're seeing now at the beginning of 2022 is we're starting to see renewed optimism for the return to office. So we're starting to see your typical fire tenants come back into the market. You're seeing 5-year deals with lawyers, accountants, more of the commodity type tenant base that we had seen kind of dipping their toes into the market last year. We're starting to see them come back in a more material way. And that's really across the board. I'd say the activity that we saw in Burbank and Culver City was very different than everywhere else in the market. Those two markets, because of the influence that the tech and media demand has had on those two particular markets, those two markets are far tighter than they were pre-pandemic. In the balance of LA, we're starting to see kind of a catch up, and there's the LOI activity is stronger across the board. And then what will follow is really the investment activity is starting to be more optimistic and stronger, to jump into those assets as well.
And what about, I've been reading a lot lately about the flight to quality. Are you seeing that across this region as well? Yeah.
So any asset that, well-located assets. So in LA, the top submarkets have been Burbank, and that's been driven by Disney, now Hulu, all of the major media type companies that have just gobbled up space in the Burbank media district right now. You've got a vacancy rate of sub 5%. Rents have jumped over 20%. So in that market, in Culver City as well, where it's extremely tight in the Class A product type, Apple and Amazon have been very aggressive in expanding in Culver City throughout the pandemic. For those two markets, there's been a massive flight to quality, and really, any asset that has come out in those two markets has been extremely liquid. In the balance of LA, we're starting to see a little bit of a catch up to that. And every market has different dynamics that will, push investors and tenants to those particular markets. We've seen increased flight to quality for markets that are closer to executive housing. So if you look out at Westlake Village, for example, that's a very strong executive housing market. Westlake Park Place is an asset that traded last year. It was 83% leased, core plus profile, but actually a very deep buyer pool was interested in that, and they had very strong leasing activity because it was the best asset in the market and it was close to executive housing. So we're seeing that theme kind of carry out into really all the different submarkets throughout LA. If you're a best-in-class physical asset that's close to executive housing, or supported by a theme, which would be, in Burbank and Culver City, that theme would be media. In Thousand Oaks, that theme would be life science. In East Pasadena, the theme would be life science. If you've got other market dynamics that support a reason for a tenant to be in that location, kind of the strongest physical asset in that market has performed very well.
Thank you, Laura. And Joseph, let's go over to you. What are you seeing in terms of the return to office and office demand here?
it's still up in the air. I mean, just like all of you and probably a lot of the people in the audience, I read about it constantly. Keep looking for an answer. There is no answer. I saw a thing the other day that said Castle security systems that only 10% of the people are using their access cards, but people aren't reducing their office space by 90%. Everybody's waiting to see. Suburban markets are doing better than downtowns. West LA, like Laura was saying, is just on fire. Culver City, Grafton, your hometown, is on fire after many, many years of just being up and down and always kind of a laggard. Now it's on fire because of the tech business. So it's really something else. I'm in charge of leasing office space for my own company. I have 2 leases coming up. I just signed one of them, and I could either COVID size my office and kind of give up on the future, or I could look to a future where I'm going to get better, stronger people. So we went actually for an expansion after thinking about it for 10 months.
I like that. Expansion. You don't hear that, have not heard that a lot in the last 12 to 18 months, that's for sure. Well, a little bit along those lines, Grafton, back over to you. Are there certain industries that are more prone to allowing or encouraging employees to really put forth more of the hybrid work model?
Yeah, Jody, I guess I would define it as knowledge-based workers. As we kind of said earlier, the 5-day work week, as we know it, is pretty much gone, right? The crisis pandemic has just amplified those trends significantly. But to further dive into the uses, I would say it's financial services, professional services, and certainly tech and media are adapting hybrid models right now. All these firms are densifying like crazy, as you know, for years and years and years, and now they're reversing it, either by hybrid or just physical spacing. And tech, as everyone's been saying, has been far and away the leader in office leasing activity for some period of time, and that's going to continue. And they're also the most innovative and adaptive for hybrid models. So, I think they're going to be the leader there. That all being said, we hear more and more C-suites saying they need their employees back in the office for culture, collaboration, and productivity. But it's a matter of when and how they're able to do it. Not just COVID, but a really tight labor market, has an impact on that too.
Thanks, Grafton. Laura, we spoke a little bit about this in the first open question in regards to the kind of office space that's outperforming in the market. Definitely, you touched on the tech, media, the content creation that is in this market. Are there any other users of office space that you've seen that have been doing well over the course and potentially outperforming, in addition to the Amazons and Googles?
Yeah, we really should mention new product types that have come to the market or conversion of certain types of office space really post-pandemic. And what we've seen is in the studio space, and it's really stage space, that market has been completely converted post-COVID. I think it started because a lot of the film and entertainment personnel couldn't travel. So where you previously saw a lot of travel to Canada, New Mexico, locations outside of LA, you had kind of the combination of massive demand with the content wars and the streaming up just a dramatic amount. And then you had the inability for the talent to travel. So what you saw is really utilization days for stages, which typically hovered around 75%. They were all at, between 90 and 100%. And so there's been a dramatic shift in any type of space that could be converted to a stage. Some of the space by nature is industrial. Some of the space is office that's convertible. There's really been kind of a look to see how could we convert the space. And you've seen probably a handful of players that have been really, really active in the acquisition of stage space. And then the second really theme that's been very, very active post-COVID has been life science. And we've seen just the depth of capital for life science investment in Boston, parts of Seattle, San Diego. It's been all-time highs. Rental rates are up over 100% in all of those markets. And really in LA, the depth of capital is there. We're starting to see leases be signed for life science type use. And there's really kind of a desire to establish a life science node in LA. I don't know that we'll see one node, but we will see several mini nodes start to form. And we're seeing that happen right now. So there's a deal that's been signed in East Pasadena and a very deep tenant pool looking at several assets that would be converted. So these are traditional office or industrial buildings that have the physical attributes that allow them to be converted to a life science building. And those attributes would include, you need high ceiling heights, strong live load, proximity to talent, proximity to university or hospital. So East Pasadena has those dynamics. Parts of Thousand Oaks have those dynamics. And we've seen, we're working on an asset right now in a market where there's been 5 trades on the same street for office buildings and industrial buildings that are being converted to life science. So that's been a very strong buyer pool. And then the other outside of Culver City and Culver City, Hollywood, and Burbank, where the media market, it's its own animal. Really strong physical asset, Class A asset, and proximity to executive housing. I think those 3 themes have really driven both leasing to date and then LOI activity moving forward. And I will say across the board in all of the different buildings we're working on, the LOI activity has been extremely and surprisingly strong in the last, I'd say it's been dramatically different in the last 3 weeks. So a good general theme for the market, office market.
Absolutely. Joseph, talk a little bit about law firms and what you're seeing there. Historically, having been heavy users of office and office space, what are you seeing with regards to law firms and what they're doing with space?
I love this story because I saw a survey that was done by a big New York City law firm of their own internal attorneys and asked them if they wanted to come back to work. They said, absolutely. Do you want your own office? They said, absolutely. But we're not coming into work more than 3 days a week. They don't want to share offices. They don't want to hotel offices. And this is a unique group of people because they actually pay for their own space. The attorneys in a law firm actually are the ones paying for their own space. So at the end of the day, maybe they're just as confused as everybody else, but at the end of the day, they want a sense of place. They very much miss collaboration with other partners. They don't know how on earth they would ever integrate young associates into their fold without having face-to-face contact on a daily basis. So I love that. I love that story because that's talking about people that know both sides of the ledger. Mm-hmm. What you were bringing up before, Jody, there's been quite a bit of increase in the type of product that offers lots of amenities. The Enclave down in Torrance, Paso Arroyo in Pasadena, the Met down in Costa Mesa, an old tired 3-building complex just off the freeway that they opened up all sorts of common space to, and they all leased for rents above market. So it's kind of telling us something that's the product that the companies that are going to be taking more space, that's what they want to gravitate to.
That segues well into flexible space. Grafton, you commented on how you have seen clients change the way that they look at space. So what are you seeing in terms of flex operators, and what role will flex space play in this transition of back to work?
Yeah, so flexibility is key. It's critical right now. And it's critical for larger users to flex in and out of space. And I think you're seeing a lot of smaller users that, traditionally would lease 3,000 to 4,000 square feet, 3 or 4 private offices, a couple secretaries, moving into co-working spaces. So flexibility, having flexible space means, co-working space, spec suites, plug and play space is really popular right now, where it's, you got the furniture and IT, everything's ready to go. Those are all important elements for either large, institutional landlord assets, or institutional landlords in their portfolio need to be thinking about that and have that in there, because it's just extra arrows in their quiver. A lot of tenants are coming back, but saying, I don't know what's going to happen in 3 years. So, I want to do a couple of year lease in co-working or at a plug and play space. And flexibility also, not just in the type of space, but in the term lengths, right? And having a lot of these deals be low CapEx for users, finding a creative way like that for the owners. I think that's really important. The reality is, I think right now, landlords and tenants, look, we're all going through this together. I view it, it's not so much like an adversarial thing. It's more like, how are tenants and landlords going to work together in these environments so that we come out of this stronger together? And the smart landlords are addressing it by having just all different kinds of offerings, and tenants are taking advantage of it.
All right. We have now entered the speed round. We only have 3 minutes left, so this is going to be very quick. Laura, I'm going to start with you for the first speed question. We have seen a lot of pandemic-induced factors affecting commercial real estate. One example is tenants signing short-term leases over really the last 20 months. And, how do those types of factors, such as that one, affect underwriting?
I think what we're trying to see, flexibility obviously is key. Flexibility is key. Proximity to executive housing, like we've talked about. And I think just acknowledging, every company seems to be acknowledging that the collaboration, I think Joseph mentioned this before, collaboration is a massive part of most industries, particularly knowledge-based industries, and getting those groups together, especially in an environment today where you are starting to see the idea of herd immunity. I can tell you we've got a 30-person team, and in January, every single person who had not yet had COVID got COVID. So you are seeing anecdotally in LA, just the numbers of people who have some type of immunity are higher. And we're starting to see actual dates be set. Nike released that they're sending employees back to the office May 3rd. We've seen this before, but the physical date being set with a combination of perhaps more employees who have herd immunity, I think that combination will bode very well for the return to office.
Thank you. All right, Joseph, speed question for you. Other than flexibility, what do you think office owners will need to account for over the next couple of years?
Well, I find it truly amazing that with vacancies kind of sky high, the asking rental rates have kept going up. It kind of flies in the face. I think that a lot of people would be tempted to take more space and take it earlier if they saw there was an advantage economically to doing it. And not every tenant in the marketplace can do net effective rents and put chalk lines in the floor, take only so much space now and so much space later, and all the sophisticated things that we use in the tenant rep business. But I don't think that's going to happen. I don't think the lenders are going to allow it to happen. I know of one very aggressive 100,000 foot plus law firm deal in downtown Los Angeles. They drove such a hard bargain that the lender came back to the owner and said, you have to put in more equity. So you can only push it so far before you start to run afoul the institutional owners behind all this. But everybody that I hire, they still want to see the office. They still want to see where they're going to sit. And I think that's the same is true in tech. My son's in tech. He worked from home for a while, and he missed being with people.
I agree with your son. I miss being with people too. It's good to be at least somewhat back.
Yep.
All right, Grafton, speed round. What do you see that office owners are going to need to account for over the next couple years here? Did we lose you, GT? If not, Laura, pipe
I got
in.
it.
What do you see? We're back. Grafton's back.
I'm back.
All right.
Yeah, I was just going to say, I think two things. One is the actual physical act of getting people back in the office, right? I mean, all the restaurants and gyms are shut down. How well, the vacant spaces are being maintained, electrical systems, mechanical, HVAC. So they got to get that stuff ready for people to come back. And then secondly, all of these users, particularly, are all wanting something new and different and exciting and magnetic to get their employees back, to get them excited to come back to the office, where they realize that they're having an experience that they're not going to have at home, like Joe's son and you. But so the owners need to look at their assets as prudent owners and say, how do I partner with my tenants, and improve my physical asset vis-a-vis amenities and indoor-outdoor spaces and activities and sort of bonding environments to match that and have a product that these tenants will want to come to in my asset. So it's kind of part operational, and I think it's also part sort of construction and design oriented.
Thanks, Grafton. And Laura, final word. What are your thoughts on what owners need to account for?
Yeah, I think, the owners have been, in all the buildings that we've worked on, the owners have the asset managers have been very busy through COVID, doing just what Grafton mentioned, keeping the lights on, keeping the electrical systems running, keeping HVAC on and off. So that part's been actually keeping these guys pretty active over the last 2 years. I think it's going to come down, not necessarily from from landlords, certainly for new leasing activity, but really there's a massive existing tenant base that's got to just start drawing a line in the sand and saying, our return to office as a company for Disney, as a company for Anthem, as a company for all of these large LA-based companies, our return to office is on this date, and it's going to look like 3 days a week, or there'll obviously be a flexibility component written in there. But once we start seeing firm return to office dates set, certainly with flexibility layered in, I think that will help create some type of template for other companies moving forward. And we've seen, I know our team's been back in the office for the better part of 18 months. I can tell you the people that came in first were the people with little kids who just realized that working from home I've got a 4 and a 6-year-old. I'm not doing work from home. It doesn't work with kids screaming in the background. So it was really easy to get me back. But, every person had their own set of reasons why they chose to come back. And it was actually surprising to see when it was an elective basis, a lot of people did choose to come back for the collaboration and, desire to be around their peers.
Thank you, Laura. Well, I look forward to hopefully being around all of you at this event next year in person. So thank you to Joseph, Grafton, and Laura for your time. And Josh, I'll pass it back over to you.
Yeah, thank you. What a great way to kick things off. I'm hearing there's a lot of wait and see. I think there's answers still to come that we're all looking for. Grafton, you mentioned a stat that I thought was particularly interesting about the 1.5 average days of remote work. I think intuitively, a lot of us might have thought that was significantly higher. So that's interesting. Joseph, Laura, Grafton, Jody, thank you all for kicking things off with a really important panel. Next up, we're going to talk about industrial trends. So let's meet our experts. First, Phil Bond, Executive Vice President, Chief Credit Officer with Farmers and Merchants Bank. Mike Condon Jr., Vice Chairman, Cushman & Wakefield. Lisa Reddy, Vice President, Leasing Officer, Prologis. And our moderator today, Asher Lozado, President of the Lozado Company. Asher, welcome.
Thank you. And welcome to everybody who's listening in. I'll just do a short introduction about myself, but I'll get right into it. Our company has done a lot of conversion work. We've done a lot of converting industrial space into creative office space, which has been very successful. And it was interesting to listen to the last panel because I think that we are very attuned to some of those trends, and I think that they overlap industrial and office, and I think they will continue to do so. We're seeing a lot of tenants very interested in beautiful creative space that is old industrial space. And so we're finishing Sweet Green's headquarters right now. We just finished Goat's headquarters, the Real, Red Bull, and they all are committing to industrial space that's been converted for the industrial space that's not in demand otherwise. So anyway, we're a family office. We represent a lot of high net worth individuals and trusts and stuff. So we might have a little bit of a different perspective than some of the people we'll be talking to today from an institutional standpoint. But I think it's all valuable, and I think all of us will be playing our varying roles in this next cycle. So I'll get right into it. And by the way, if anybody after this wants to email me, I'm always happy to just talk to people, especially young people who are interested in the industry. And you can just email me directly, and I would love to chat or whatever is good. All right. So first question for the whole panel. We have 2022 starting. Obviously, there's movement as we've discussed in the office segment, but from an industrial perspective, Mike, what are you seeing?
I mean, that's a loaded question. Industrial pricing is absolutely on fire right now, both on the leasing, the low levels of vacancy, almost zero on Class A space. Primarily, we're seeing pre-leasing in the market. Land we're seeing approaching and exceeding $200 a foot, and rents we're seeing Class A infill locations at more than $2 triple net. There's also been just additional deal terms that we've been seeing, limited to no concessions, almost no free rent. We've gone to 3 to 4% escalations, and we're frequently hearing from a lot of our industrial tenant rep friends. They are no longer taking on new clients. It's just too tough and too tight out there. So it's a great time to be an industrial landlord.
Great. Thank you. And we've seen your name all over the city. So good work.
We try and mimic you, Asher. When I got into the business, I followed you, and it's the confluence of industrial with office that we're seeing in the greater LA market. If you're an Inland Empire broker or owner or operator, it's a different beast than what we're seeing here in greater LA and the infill areas. There's so many different collisions and confluences of different types of uses that are trying to take advantage of what was traditionally manufacturing or logistics space, where high clear is now not only just in vogue from a taste perspective, but from a use perspective on a tenant's needs. There is more demand for high clear space. And all that is just making for what is turning out to be one of the tightest markets in history.
Yeah, agreed. And Lisa, your thoughts?
Yeah, similar to Mike, across the country, we're seeing pent-up demand for logistics real estate. I mean, this is really a result of the shift to e-commerce and also companies building more resilient inventories. Most of the occupiers are looking to hold more stock on hand. So this warehouse stock will be held by wholesalers and 3PLs, primarily near transportation hubs and large population centers. And this is keeping vacancy rates at record lows. We're seeing this trend take place here in Los Angeles with industrial vacancy, at or just under 1%. Yeah,
and you certainly have a really good perspective on that. Prologis being best of the best. Yeah, so nice work. Thank you. And Philip.
Yeah, I'd echo the comments of Mike and Lisa. The market is very strong right now for industrial across the greater LA region. From a long-term outlook, we're very bullish on it. We're active lenders in the space. From a short-term perspective, I think just around the margin, you're seeing a little bit more risk creep in as everybody begins to plot for the next big lofty profit opportunity in some of these deals. I think Joseph's comments back in the office side of things about the rental rates, at some point, those will hit a high water mark, and we just have to be thoughtful about, from a lender's perspective, where that mark is and is the right tenant or owner occupied facility there for us to make a loan on.
And what do you think from the deals you look at, and I'm sure you see a lot, what do you think are some kind of X factors that drive rents up, and aspects of particular properties that might drive rents down, things that are missing, amenities or structural sort of issues? If you could talk a little bit about that.
I think part of it's been touched on. The transition of some industrial space over to creative office is changing the mix of some neighborhoods. I think industrial folks tend to like being close to other industrial folks. So I think that'll influence a little bit just from a who's in the neighborhood perspective. I think your point there, other amenities, ingress and egress, there's just a lot of traffic on the streets these days. And I think it'll be more critical for having greater ease of being able to get into the property and get out, especially during peak hours. I think those will be a couple of factors that we'll see start to creep in. And then willingness as well for folks to do kind of sale leaseback deals. I think that'll be very important. Your traditional owner user who's owned the real estate, operates the business out of there, they may be more inclined going forward to do a sale leaseback, which will certainly have an impact, I think, out there as well in the market.
Thank you. So I guess moving to Lisa, how much demand do you see for warehousing space as a particular use case versus other kinds of uses in industrial space?
If Lisa says anything but unending, she's lying.
No, I mean, it's true. Hey, I mean, you mentioned it, Asher. Prologis, we operate a portfolio here in LA, 36 million square feet across 300 properties. And we do not see a slowdown for demand of our logistics space, both, new Class A, but also the older inventory. According to our Prologis research that was released earlier this month, demand for industrial space continues to outpace supply. And we think this is going to be the case until 2023. Land for new logistics real estate is scarce and demand remains extremely high. So companies who are searching for more warehouse space that can't find new construction are actually broadening their search criteria. So, for example, I've seen it in my own, customer base and also new potential customers. Users of logistics space are willing to explore a different submarket within LA, for instance, if they can't find the initial submarket they wanted, or they're willing to settle for alternative building characteristics such as lower clear or shorter truck court. So, in the past, when demand wasn't so high and supply wasn't so constrained, these compromises wouldn't be made for search criteria, but we're seeing that they are.
Asher, I'll jump in. I'm looking at this and it's just saying industrial trends, and it's speaking out to me because I'm looking at Lisa as well. One of the most interesting things that I've been seeing, and Asher, from your business model, converting old Class B and Class C into creative office, I never in my career have I seen when a industrial REIT or a Prologis type group goes head to head with a creative office developer. I've never seen an inflection point where industrial, based on the economics and fundamentals of their underwriting, is actually winning out. And over the last, call it 6 or 7 months, we've been starting to see these head-to-head competitions in markets like Hawthorne or Gardena or some of the more fringe markets that are expanding for creative office, but are also prime industrial locations where a Prologis or an industrial investor who's going to scrape the site and go modern Class A industrial is actually winning out over the office redeveloper. And that's just because the returns are lower. The vacancy is, it's a very efficient market, and where your rents are going to be. You're seeing double-digit rent growth year over year. And so now industrial investors are able to project out and have a better business thesis than a creative office rehabber. And I've really never seen that at any point in my career. And that's probably one of the most interesting trends that we're starting to see in infill LA.
Yeah, I agree with you, Mike. And I think we've found success in the areas where there hasn't been a high concentration of industrial. There's been a slow conversion. And so the market is sort of at that precipice where once you take one of the big buildings or a few of the big buildings and convert them to creative office, it changes the character of the rest of the neighborhood. And I think that's what's happened in LA. We were one of the earliest kind of investors in the Bergamot Station area. We owned the properties around Penn Factory, Red Bull's headquarters, and that was all industrial Santa Monica. I mean, that was Santa Monica's industrial area, really. And it just took a couple of tenants and then it pushed it. And, Red Bull took 100,000 feet. And then all of a sudden it was a creative office area with food trucks and all the stuff that comes along with that. So, I think it's really interesting to see that now kind of shifting back the other way. But yeah, thanks for that, Mike. Philip, there's a lot of volatility, both in supply and demand. Are you thinking and feeling that industrial real estate is still a good investment right now? Knowing the opportunity cost, knowing the context, and do you think that there's continuing upside? I mean, real continuing upside.
Yes, I mean, we regard it as a very desirable property type for us to lend to. We think the long-term outlook, for all the reasons mentioned, is very positive to date. But we do make bridge loans. We make everything in between, all the way up to 10+ year term loans. So we're always trying to be mindful of not only supply and demand issues, but use issues as well. From a value perspective, I think as we start to see interest rates finally start to turn up, with money having been just way too cheap here of late, that'll certainly be one factor that will slow down the increase in value. But I think there's a very good reason to believe that industrial property here in this market is a very good store of value, and got very good long-term prospects.
And do you think that the inflationary pressure in terms of construction costs goes to support that thesis? That if you own something that's already built, it's going to be impossible to compete on a cost per square foot basis, right?
That's right. I mean, land costs today are just astronomical. Materials clearly are at elevated levels. Labor is only getting more expensive when you can find it to show up on the job site every day. So those factors there, I think, will definitely influence things here in the near term until there's some shakeout with regards to those values.
Yeah. So, Lisa, getting back to you, there are a lot of opportunities, but I think a lot of us have been sort of circling this idea, but there's also a lot of challenges, and there's a lot of saturated competition. There's a lot of people looking at industrial, seeing how good the trends are, competing for the same product. How does that bode for your clients, for people who are leasing from you, and how does it bode for you?
Yeah, I mean, echoing what Philip and Mike said, building logistics real estate, especially here in greater Los Angeles, is more expensive than in the past. Building and land prices are at record numbers. And the price of construction materials in 2021 actually rose by 40% in the US, according to our internal Prologis research. So this, coupled with construction timelines increasing because of entitlements, supply delays, shortage of construction workers, this only heightens the competition for developable industrial land. And logistics land is scarce, and land prices, like we said, are increasing here in infill markets, but also outside of infill markets. So, companies who are looking for logistics real estate will face competition among each other and also challenging conditions to secure space. I mean, rents are escalating. As Mike mentioned, concessions from landlords are going down. So these users will really need to plan ahead and also think about potential contingency plans.
Yeah. Mike, maybe going back to you for just a moment on this, because I think you had an interesting thought on some blended sort of hybrid industrial uses, maybe an industrial user that's warehousing, but also potentially opens up for pop-up, for the public one day a week, or it's sort of a blended retail industrial so that you bring some foot traffic. But what are some other ideas? What are some other models you're seeing with respect to industrial use as this competition heats up?
Yeah, it's fascinating. I mean, robots and technology galore. You couple that with production was spoken about on the last panel, but that's effectively LA's life science. The production boom is real, and it's gobbling up column-free, high clear space as much as it can be turned over. So right now we're seeing life sciences, we're seeing production with the emergence of companies going out public via SPAC. We're seeing a lot of aerospace, new aerospace companies, electric vehicle companies, and all of these companies are looking for cheap office space, but also to be able to do their manufacturing and R&D. And so there's this confluence of different types of user groups that are all fighting for the same types of space. I'll give you a great example. We sold a 10-acre site in Gardena to Overton Moore and Invesco last year. On the site, there were about 250,000 square feet of Class C legacy improvements that theoretically nobody in past markets or cycles would have used. The intent and the plan for the site is to scrape it and redevelop it. We told Overton Moore and Invesco, hey, let us take a run at trying to lease the existing improvements, maybe hitting a higher return. And we've had professional sporting teams. We've had Fortune 100 production companies. We've had modular housing manufacturers, and we've had a variety and a slew of different tech companies all coming through the project. And I'd say it's not just the emergence of e-commerce in the LA market, but it's the emergence of these other tech and growth industries that are starting to grow within LA that's creating this scarcity with industrial space. I can just tell you, we've been tracking, we have a team of 12, and half of us do sales, half of us do leasing. And in a market like the Arts District, which is arguably one of the most dynamic industrial and creative office confluence markets, we've been tracking on the office side about 4 million square feet year over year of requirements, of which 25% or 1 million square feet of those requirements had a requirement for high clear space. So I do expect that these collisions between use types and food groups will continue to happen. And it's just one more reason why industrial rents are exacerbating and at all-time highs.
Yeah, we're seeing the same thing. We own the Shelby Cobra, the original manufacturing facility in Marina Del Rey. And CAA had taken it as creative office space. And now that's kind of B, C improvements, but it has great clear height from back in the day when they were making cars there. And we're seeing aerospace companies, gaming companies that, want to also host events. And it's just that I agree with you that space has a lot of potential for a lot of different uses.
Now, the one caveat I'd say to that is that's more South Bay and more traditional infill. We're not seeing as much of the competition in more of the central LA and mid-counties markets. That's still primarily reserved for more logistics and warehouse users. But as there is more demand for high clear space, we do expect that the radius of search for those types of differentiated types of users will start to spread out, as we've seen. As what Lisa said, it's a flattening of the submarket where it used to be we'd see a 15% rent increase on industrial space in the South Bay. We've now seen that spread on South Bay versus SGV versus Central LA market. The market's so tight that it's really starting to become one ecosphere for rents.
Yeah, totally agreed. So, Philip, from an underwriting perspective, how are you looking at valuation right now? What are you doing to sort of try and understand value differently than others might be understanding value? Yeah.
That's a great question. With the remarkable run up in values over the last several years, as a real estate lender, we've had to be really thoughtful about what's driving that value. So is it that it is Class A, it's in an absolute traditionally great market for that product, or kind of on the other end of the spectrum, is there a little more speculation around its next life, let's say, going from industrial to creative office? And if there's a little bit more speculation associated with it, then we're trying to be, again, very thoughtful in terms of the sponsorship, the equity source, the experience of the individuals involved in a potential transition from, as Mike and Lisa were saying, from industrial, let's say again, over to creative office. So we're trying to be very specific about those marketplaces. We're trying to make sure that we're out and about with our clients, prospects, and folks of the caliber on this call here to make sure we have a keen appreciation for where the values are today, and as lenders who make long-term loans, where they'll be at in the future.
Philip, I got a question for you. So we get calls from lenders or capital partners about where the market is. And I could tell everyone on this call, well, there's an industrial deal going down in Torrance at 215 triple net, right? And I'd tell you that's where the market is today. And you'd tell me, hey, Mike, go get some comps to support that. And I'd tell you, look, the comps are happening so quickly and each comp is setting the market at a new pace. How, as a lender, are you making heads or tails when we're seeing rents increase, 5% a month in some instances for industrial?
No, it's a great question. It's a big challenge for the appraisal industry to chase those types of transactions to see if they can process those from folks actually putting money out to work on those particular deals. I won't try to tell you that we're normalizing those back 2 or 3 years, but we're just really trying to challenge ourselves to see how sustainable we think those are for that particular tenant or owner user of those properties. And what does that look like over the life of the loan? Is that going to really be sustainable? And we're trying to avoid the trap of kidding ourselves that 3 or 4% bump, in the years to come is actually going to be enjoyed if there is an economic slowdown.
There will never be a slowdown.
We'll see. That leads us to our next question. On a scale of 1 to 10, 1 being big slowdown, 10 being continued run up at existing pace and scale. Let's start with you, Lisa. 1 to 10.
I live it and breathe it every day. So I'm placing my vote closer to 10, and I'm putting my money on growth. Just from my perspective, and I'm on the leasing side for our company, it seems like supply chains are going to continue to evolve, but this evolution won't be immediate. It will take time. So the evolving supply chains will drive and respond to conditions across logistics real estate, coupled with pent-up consumer demand and, the need for more warehouse space to satisfy the supply chains should keep vacancy rates at near a record low. So, and this, I think, will even be the trend as completions pick up. So in turn, all of this, will continue to push rent growth.
All right. And Philip, 1 to 10?
Not quite as far out towards 10 as Lisa, but I think it's definitely comfortably in the 6-7+% range. We have to take a look at the rate of growth in value, the fuel for that being in part very cheap money, lowered expectations on the return front for investors. And at some point, the tolerance for tenants to pay higher rates is going to top out. So I think there'll be a dampening. I'm not calling for it necessarily this year, but again, 1 to 2 years, and there's got to be a little bit of a slowdown here, I think.
Yeah. And Mike?
I would go, my answer is at 14. It's a 1 out of 10, right? 10 being the highest. I'd put us at 14. We're going through an absolute fundamental paradigm shift with industrial that nobody on this panel or anywhere else has ever seen. You talk to any industrial broker out there, they'll tell you they can't make heads or tails of it. And the reason being is that COVID obviously accelerated a transition to e-commerce where grandma and grandpa usually would not have gotten on board at such a rapid pace. It would have been a longer phase in for people to adopt the new technologies and the new way of life. And we basically had it slammed in our face over a 12-month period. So I actually, 14 to 20 maybe would be my guess. But it's not just the fact that industrial real estate's so hot. It's the fact that we're starting to see cities and municipalities become NIMBYs more than they ever had before. So where you have by right industrial zoning historically, we're seeing cities like Carson or Rancho Cucamonga and other cities in the Inland Empire where they're historically warehousing cities are now being putting industrial moratoriums on logistics buildings. So aside from the increased and propelled demand that we're seeing, there's also a slew of land use components in municipal ordinances that are going to prevent the construction and expansion of new industrial space. And I think that as much as anything else, even with just the users groups shift in developing tastes, the restriction of local cities and municipalities to allowing new industrial product will be as impactful as anything else.
Great, thank you. And the enthusiasm is contagious for sure. I think it's always, I tend to have maybe a healthy dose of skepticism, but not in a really negative way. Just I believe in that all markets sort of come to a homeostasis and they balance out. And if industrial space gets too expensive, then all of us creative office users or other users might say, hey, you know what? This is the creative office is now a good deal, which is a crazy thing to think that really well done office space could be considered a really cheap comparative deal. And that might actually help inspire. And I think it will. I think it will inspire creative office to continue on its trend too. So I think it's sort of an all ships rise situation. And so, all really good input from very, very, very smart and successful people and people who are well respected by everybody in the industry. So thank you for your time, your thoughts, and we'll turn it back to the hosts.
Great. Thank you so much. I think the 3 words that really summed up that panel was just market on fire. So we'll have to wait and see. Asher, Lisa, Mike, Phil, thank you again. All right, rounding out our topics, we're going to learn about what's on the horizon for development. And then next week, we're going to see some of these projects of the past and see how they transition into the future. So please welcome Ted Hyman, Managing Partner with CGF, Larry Taylor, Founder and CEO of Christina, Alex Valente, Senior Vice President, Trammell Crow Company, and our moderator, Kofi Nardi, Chief Executive Officer with Global Red. Kofi, welcome back. It's good to see you again.
Good to see you, Josh. First I want to say thank you to you and the LA Business Journal for putting on such great events, bringing together, thought leaders and industry leaders to have these robust conversations from an interdisciplinary approach. So thanks to you guys. Great panel so far. I've been taking notes myself. Again, my name is Kofi Nardi, the founder of Global Real Estate and Development. We're based here in Beverly Hills. We have a development business, residential real estate business, and global business and development partners around the globe. So we're going to jump right in to our amazing panelists. First, we're going to address the entire group. We've heard about office and industrial trends here. Is there a development trend that's gaining traction that you never would have predicted, let's say 10 years ago? Why don't we start with you, Ted?
Sure. You heard it. I think one of the 2 things, well, you heard both the things in the other 2 panels, but I'll just reiterate it. I mean, biotech and research is, 10 years ago, 5 years ago, we probably had 4 or 5 developers that were building probably 80% of that work. And in the last 2 years, every developer we know and every building owner we know that has a building that's underutilized is trying to convert it to biotech. And I would just say, be careful because, if you're not doing it right, you may spend a lot of money to retrofit a building that isn't going to work long term for you. The second thing is this adaptive reuse. And, we did the Spruce Goose, for the Primary Colors tech company a few years ago, the hangar. And I think what was really amazing, it changed the bar for Google, certainly. Oops, for those guys. But it's really about creating authentic space. People today want these kinds of spaces. It's not just a warehouse. It's really creating that authenticity. And it's actually really exciting. But those are the two areas that have just exploded for us.
How about you, Larry? Can we have Larry there?
I got to unmute. There I am. Sorry, folks.
All right.
I've spent the last 45 years focused exclusively on the west side of Los Angeles. And so, for all, in all due respect, if it's not on the west side of Los Angeles, it doesn't capture my attention at all. So, my comments are limited to Westwood, Brentwood, Santa Monica, Beverly Hills, Century City, West Hollywood, Silicon Beach. And, 10 years ago could not have predicted the virus, which has materially changed a lot of things. But, besides that, the two things that I think are most significant, in Los Angeles, particularly the west side, are the TOC, which is the density provisions for transportation corridors, which is allowing us to see a lot more redevelopment because there virtually is no land on the west side. We've never seen any period of time where there hasn't been an increased demand on the west side and a lack of supply. So that's nothing new. But the TOC is starting to show higher density in areas that are at or near transportation hubs, which we could not have predicted 10 years ago because it didn't exist. And also the seismic ordinance, which virtually nobody talks about, which is something that was passed a number of years ago, largely led by Eric Garcetti and others in the city, which basically shows tens of thousands of buildings on the lists of unsafe buildings in Los Angeles. About 80% of the apartment buildings in the west side of Los Angeles are in danger of collapse. We're more likely to lose more people to death from an earthquake in these buildings and collapsing than there would be a nuclear bomb. So, the opportunities to basically repair, replace, and rebuild 80% of the west side is something I would not have predicted 10 years ago. And it's the least thing talked about, but it's certainly something that I could never have seen, in 2012.
Yeah, that's a serious factor to contend with. Alex.
Sure. Thanks, Kofi. Just thinking about the question, I think just this whole build for rent phenomenon, at least for us in Trammell Crow Company, we've been around for 70 plus years developing all product types. Never had we done single family for rent, and now we're looking at it very seriously here in Southern California and in a few other markets. So just if I had to put on my time machine hat, I don't think we would have seen that coming. Maybe, you saw folks investing, Invitation Homes, et cetera, into single family, going back probably about a decade plus, but just the whole phenomenon of, big institutional developers like us just jumping into the single family build for rent game, especially in Southern California. I wouldn't have predicted that 10 years ago.
Yeah, some of our international business partners are seeing the same thing. We're doing some marketing and sales work for a company called Oasis that's building exactly that, building single family villas in resort destinations just to sell and rent them and manage them for the owners. We're seeing great demand for that. Transitioning to the next question, this one's for Larry specifically. What can you say about the resiliency of Los Angeles real estate market in regards to recovery from the downturn? Larry?
Well, for the past 45 to 50 years, I've been through at least 5 or 6 downturns. And the one thing that I can say with great certainty is we always recover first, and we always recover to a higher high. And that's because we have the best year-round weather in the world and best year-round weather in the United States, and a lot of other factors that make us the best place to be. So I've never had any concern of the resilience. In the last 45 or 46 years, we've never lost a penny on a real estate investment. And there's not a property we've sold in 45 years that we could buy back for what we sold it for, which, goes to show that it's not only resilient, but it's probably one of the most high demand locations in the world.
I couldn't agree with you more. I had a conversation earlier today about that with someone who's a good friend and developer on the East Coast, and they were explaining how everyone's leaving LA. And I said, well, listen, not to be crass, but there's a but for every seat in LA just because of the weather, the environment, and the lifestyle. So I couldn't agree with you more. Alex, we're seeing a lot of new trends in multifamily as a result of COVID and new work from home lifestyles. What amenities are residents interested in today?
Thanks, Kofi. Everything, every project, every resident is kind of expecting things like a washer dryer in unit, pet spa, dog run, barbecues, et cetera. And everything's kind of going indoor, outdoor. With work from home, clearly, you have to have a work from home dedicated space. We just did a project in Chinatown with a collab, a work from home space that has been really well received. We actually delivered during the pandemic, and it's sort of, I think it helped with what's been a really great lease up for us in downtown. But maybe taking just a slightly different perspective from all those kind of conventional type amenities that we're seeing. I think it's kind of the service side and the community engagement that we're mostly focused on. I think even with COVID, I just think there's a lot of sort of these more suburban type locations here in Los Angeles that have sort of a hint of urbanism where you can really kind of walk to things but still jump in your car if you need to. I just kind of point to everything along the Gold Line. I just think there's so many cities around there where, essentially the neighborhood itself is an amenity where you can get a little bit outside the city center. So I think, just everyone's been so, conscientious and about their living quarters, especially over the past 2 years. It's such an emotional decision, just living anywhere than, having to spend so much time, indoors potentially like we've been doing for the past 2 years, that everyone's really focused on, hey, where the heck do I live? What can I walk to? What's immediately accessible? And I think, as a developer, we really try to kind of lean into that always, but also specifically the last 2 years, just making sure we're reaching out and outreaching to all the local neighborhoods, bars, restaurants, and just doing all sorts of special things that build community within our projects. And I think, and that in itself is, I would call an amenity that's sort of in fashion, extra fashion right now.
Agreed. It plays into the lifestyle of every development that you're working on, right? So we hear a lot about companies focused on ESG. Ted, your firm is known for pushing the boundaries of sustainable development. How can architects work more closely with developers to ensure commercial spaces are developed in the most sustainable way possible?
Great question, and one that I'm incredibly passionate about. I think the bottom line, 10 years ago, we were saying, well, it's 5 or 10% more to build, high performance projects. Today, it doesn't cost more. In fact, I think we can build a business case almost every time that it's cheaper. So if you're using architects that are telling you it's more expensive, you need to push on them or get a different architect. I mean, just to prove it, we just finished California Air Resources Board. It was design build competition, low price, got the project. We built it. It's over 400,000 square feet. It's net positive. We're generating 7% more energy on site than we need to run the project. And it was the cheapest submission. So I think you can do it. The other thing that's happening that we're really excited about, because I think there's no excuse for not building, buildings that aren't using, have very low carbon footprints from an operational standpoint. The other thing, we're seeing it now, we're getting questions from our developers and from their funders even more. I mean, Ventus, who's funding a lot of our projects, is demanding it now that we start tracking our embodied carbon footprint as well, the kinds of materials we're using for the projects, and really starting to look at reducing the carbon footprint of those. We're building an airport in Portland right now. The entire structure is out of wood, which seems like it's going to be more expensive, but Portland is going, we want to infuse this cost of this airport back into the local economy. So all the wood that's being supplied is coming from, native persons, farms, and very small family farms to really pump the money back into the local community. So if you're not getting that kind of stuff out of your architects, it's time to talk to somebody else.
When I was reading about your firm online and I saw that you guys designed what you call the 100% agile office, I said, these guys are creative. I absolutely love that. And I think sustainability is critical with development because even development in general is part of what creates the need for sustainability and cures sustainability. Half the world is underdeveloped. So we do have to continue to build to create efficiencies in these underdeveloped places, right? We're even looking at how we can offset or carbon neutralize our developments. We partner with a company called Kyoto Network that's doing some amazing work in that regard. But let's keep going here with the questions. So back to multifamily, I'm going to come back to you, Alex. And some of the things that have made such an impact in that arena. How have eviction moratoriums impacted your business? Any lessons that the industry can learn from?
You know, we have two projects in downtown stabilized right now, both leased up and stabilized during the pandemic, about 5 blocks apart from each other. One is carrying a 20% delinquency, and the other one's at 0. So, you know, it's kind of thrown not us for a loop, but it's just made us kind of think a lot more about how to value our projects. So I think for the one with 20% delinquency, you know, eviction moratorium in effect, and just going back to, I guess you said, excuse me, the lessons learned. You know, we had different protocols essentially from the state, from the county, and from the city, all on one project. So it was just really difficult for us to kind of like weave through the different rules and impacts of all the various kind of government legislation. So I think, you know, lesson learned is trying to have a more unique and singular kind of policy, because it's just been really difficult for us to kind of keep track of what's what. We've had valuation issues too. Just, you know, if you got 20% delinquency and you're trying to figure out the value of your project, if you're selling your project, you know, who's the benefactor of the rent relief? Is it the seller? Is it the buyer? I mean, all sorts of things like that, weaving through. Is it the time of application when you put the application in that should determine, you know, whether or not where the rent relief goes? So it's been a little bit of a maze for us, kind of figuring it out. And it's also been just kind of fascinating, just having these two properties right now in downtown that, again, so close geographically, but just so far apart in terms of like the impact of the moratorium and the impact of all these rent relief efforts.
Yeah, it's a challenge. It's a challenge for developers as they're planning what to do with their existing developments and for future developments. Future proofing in this industry is a major challenge. We're entitling projects that won't be completed for 4 or 5 years, and we have to figure out where the market's going to be and really build to those needs. So Larry, we look at today's investments and how they're getting a lot more complicated, really across the board. What type of real estate investments is Christina, your company, focused on currently?
Well, interestingly, I've never felt real estate investment to be complicated. I kind of got in this business because it wasn't complicated. The 3 factors most important to investors on real estate investment is location, location, location. So having stayed focused in the best locations in Los Angeles, it's never really been overly complicated. What is difficult, of course, is that those who are fortunate enough to own properties, investment grade properties in these locations, rarely if ever sell. The greatest fortunes in real estate are made by those who buy and don't sell. So besides reading the obituary every morning to see who's dies and see if I can pick up something, you know, I'm constantly talking to estate lawyers and mortuaries and trusts and bankruptcy lawyers to see what it is that we can find to buy. It's the toughest thing is to make a good buy, to be able to buy something that's undervalued at the time of purchase. So we always call it, we're in the value bought business, not the value add business, which is more typically used in the industry. But what we have taken advantage of is since 2013, when Congress passed the Jobs Act and the Securities and Exchange Commission relaxed investments for accredited investors to be able to invest in real estate. We now reach out to investors in all 50 states. We have hundreds of investors from all over the United States who are millionaires and billionaires that are now investing with us in our programmatic private equity companies. It's never been possible before. And great real estate investment following location, location, location is product agnostic. If you're on the West Side and you're buying a prime asset from someone that's owned it for 80 or 100 years, or a full block in Beverly Hills that was never available before, that kind of opportunity was never available to people outside of Los Angeles or outside of a private pool of investors that might have been groomed over the last 80 years when advertising for investors without being a registered security was illegal. So, in answer to your question, I mean, it's probably the most exciting, most dynamic, most thrilling time ever to be in the real estate investment business because of the reach of our company to investors in 50 states. I mean, we have a huge waiting list of investors that want to invest, but because of the lack of available product, it's just tough to find those types of deals. But they're out there. People are dying every day.
People are dying every day. It's a great way to end your segment there.
It's true. I mean, that's where the deals are.
It's very opportunistic. I think there's always a deal to be had in every market, right? And I think that excitement is having the awareness and knowledge to source those deals and to unlock inventory that just can't be seen by the naked eye. And where I love what you said about value bought versus value add, because we always say you do make the money on the acquisition, not the reposition, right? Additional money can be made on the repositioning, but you really have to buy smart. I think we have, Ted, we lost you for a second, but I think you're back on. So the real estate industry saw a boom in the life science development at the beginning of 2021 and has maintained that momentum. What are the trends you've seen in research and development, and how do you think the pandemic has perpetuated those trends? Oh, I think we lost Ted. Are you there?
Well, no, can you hear me?
Yes.
So, I mean, one of the interesting things, I'm at a conference on university research parks, and development. And one of the really interesting conversations was, what COVID has done is it's improved collaboration for researchers and companies around, internationally. That part has gotten actually really fantastic. Collaboration has increased. The big problem is the people in the same building as them, they're not talking to anymore because of COVID. And so this move as we come back to figuring out ways to create these intellectual collisions for people, in these buildings is really important. The other thing we're seeing, which is really interesting, is probably 10 years ago or 20 years ago now, if you were an academic researcher, you wouldn't be caught dead in a pharmaceutical company. And today you can't tell the difference. I mean, they've merged virtually, especially because of COVID and this move. I mean, we're doing more CGMP, drug production facilities than we probably did in the last 20 years because everybody is going to be able to respond much faster to the next pandemic, which what the researchers are saying is not the last one. The last thing that I think is really important is these projects for some reason, and I think part of it is Black Lives Matter, part of it is this people wanting to have an impact, especially in research, this reaching out to the communities, to the underserved communities, to the junior highs and high schools where kids aren't getting exposed to science is becoming part of the program for these places. Really reaching out, becoming, part of the solution to the disparity that's happening in research. So putting these projects in places with programs has become really, really important.
Definitely. So we have 2 questions left. I'm going to pose these questions to everyone on the panel, but we're going to ask for rapid fire answers just so we can get through both of them. So starting with Alex, what role does technology play when considering new investments or new development projects?
Playing a bigger and bigger role, especially just because everyone's so hungry for data. So, everyone kind of ends up just trying to justify their decision, which they want to do anyway, just by trying to find data to support it. So I think just using, just CoStar sites, Land Vision, all these sorts of things that we use to help us identify sites and just put together, demographics, incomes, et cetera, to help kind of get our investors more comfortable and just kind of get our own kind of internal investment committees more comfortable. Very, very dependent on data and very, very dependent on technology to help us kind of get that data, as quickly as possible to help us kind of figure out which investment submarkets we want to be in. So I think, we're always looking out for new tools at CB/Trammell Crow Company.
That's great. Larry? Do we have Larry there?
Here we go. I would say that, today's focus on technology is so critical in terms of safety, security, and health. This is really a big issue today. And by using technology for air filtration systems and being able to show that to prospective buyers and tenants is critically important. Security technology, pulling up to security gates that read your license plates and open the gates and close them. The ability to control everything in your office, your home, or your business, through apps on your telephone. I mean, these are the things that people want: electric car charging, reverse charging systems that can feed back and forth between the automobile and the facility. So these are things that are paramount. But I would say security, health, safety are the three things that are being enhanced by technology today.
That's great. And Ted?
It's the same. I would say the same. It's flexibility and how do I make people's lives easier and able to do better work with the technology. That's what people want.
Yeah. Yeah, we're seeing sort of that technological overlay at the top of the funnel with our investors and accredited investors. I'm sure Larry's seeing the same thing, where we want to make the investment management even easier for them to the actual development piece itself and the overlay of technology there and how you engage with the actual product, the end users, buyers, or tenants, whatsoever have you. So it does play a role across the board. And finally, I want to ask each of you a little bit about the projects that you're working on now. How are they different today, say, than they were 5 years ago, and what does the future hold? Why don't we start with you, Ted?
Okay. Well, it's been a really interesting couple of years, especially the last 2 months with, this exodus of people getting out of the profession or retiring. And so the amount of work that's out there and the quality, and keeping quality people has become paramount. I think all our projects today are focused on really three things. The projects have to provide a positive impact to the people that are inhabiting them. The second is sustainability. We just are going to, regardless of what our clients want, we're going to give you a building that's high performance. And justice and equity. Every project we have, if it doesn't have a justice and equity component, and we can't bring that to the project, our people aren't interested in working on them. So that's the future for us. I mean, we can be selective finally.
I'm going to ask for a selfish follow-up question here. The justice and equity, how do you actualize that? What does that mean to you?
Well, it starts with ourselves, and we're working on that, and we got a long way to go. I mean, you can go to our website, we're working on it. But it's more, and I'll just give you an example. We're doing a project right now, which is a P3 project. So it's a developer working at UC Davis, Aggie Square. It's 1.5 million square feet. And they are bringing in programs, and we're designing the space to accommodate it. Like I was saying, we're bringing in high school kids, junior high kids, getting them interested in, in science, getting them trained, to get jobs when they get out. At the same time, the programs that are going on in that place, Alice Waters, who started Chez Panisse, is moving her foundation there. Her mission is to bring healthy food to K through 12 schools throughout California, and then working with the Ag Department and the School of Education and Medicine to track outcomes on those kids. The real question is, do kids actually learn better and are healthier if they actually eat healthy food in school? And I think we all know the answer. But, working on a project that's going to prove that and change that, I got people fighting to work on those kinds of projects right now.
Love it.
It's about doing projects that are helping.
That's great. That's great. Because it starts with even raising the conversation, which you guys have done. Larry, how about you?
Okay. Well, that was very interesting, but things that we're doing now that we would not have, say, done 5 years ago is we have no interest in buying older apartment buildings and trying to add value by improving them. We think they should be torn down because they're seismically unsafe. So we're only buying buildings that we can tear down and replace with safe housing. And we never would have thought of that 5 years ago. And the other thing we're doing now is we're just buying up as much street retail as we can. Because we don't believe there's a massive desire to return to enclosed shopping malls or department stores. And so, we're just buying up entire city blocks of retail that's vacant or nearly vacant, repositioning them. And we're finding that people want to shop. They want to eat and where they shop where they eat. They want to walk around. There's very few places that are walkable in Los Angeles, even on the west side. And so we've long been focused on that, but we're even more focused on that now because retail rents have dropped considerably and generally, and vacancy has materially increased. And not just because of the pandemic, but because of e-commerce. But what we're seeing now is that a lot of e-commerce that's been established is now looking for bricks and mortar, but they don't want to go into enclosed malls. They want to be in the outdoor street scene situation. So we couldn't have predicted that before the pandemic, but we were buying retail long before the pandemic because retail was giving way to e-commerce even then. So both of those things are different than what we saw 5 years ago, and they're incredibly promising at the moment.
That's excellent. And Alex, last but not least.
I'll maybe take a different sort of tack. What's kind of different now for us on our development projects than it was 5 years ago? I would say it's kind of the required yields for investors. It's just sort of like I was just actually having a conversation about this earlier today, but where 2 years ago pre-pandemic, you kind of had to get to, 5.5, maybe a 6 yield here in LA to kind of make something quote unquote pencil. Today that's shrunk. We're about to close on a deal, probably going in at just under a 5 yield on cost. So cap rates have clearly come down here over the last couple of years. Where I think we're all, if you're an owner, you're certainly seeing the benefit of it. So it's been a big change here in LA. They've really kind of come down across the country, and maybe I'll kind of toot the LA horn here for a second, but if you're buying projects at a 3.5 in Dallas, Phoenix, or LA, I'd clearly rather be in LA over those markets, any day of the week.
Indeed. And for me, 5 years ago, we weren't doing development. This is a new step for us in the last 3 years. We've expanded our residential business into the development play and taken it on an international scale where we're working on close to $1 billion in international development projects. So hopefully I'll get to work with all of you guys soon. I appreciate your time and thanks to the audience. And with that, I'm going to hand it back to Josh.
Thank you so much, Kofi. I know we ran a little bit longer than expected, but just such great information coming out of all three of these panels. Alex, Larry, and Ted, thank you as well. I want to just thank all of our panelists for joining us today. I know that I've certainly, like Kofi, I've taken a lot of great notes today and things for us to talk about in the future. I know our audience is walking away with a lot of great insight as well. So thank you all so much. I want to thank again all of our sponsors for their support. And then those of you still tuning in, I want to remind you to join in next Wednesday, same time, as we unveil this year's award winners and finalists. We look forward to seeing you then. Thank you.